Welcome to the Real Estate 401k Show. Here are your hosts, Ryan Gertis, Mike Weinstein, and Justin Frederick, helping you build a legacy of wealth through real estate. Powered by the Real Estate 401k Group at West USA and the Frederick Team with Fairway Mortgage and MLS number 625918.
Welcome back to the Real Estate 401k Show. I'm your host, Mike Weinstein, alongside our resident partner, Justin Frederick, and one of his partners on his team, Melinda Debus. Is that right? Debus?
That's right.
The bus. That's a great, you should be playing football. All right. Anyway, so we are here. Interesting topic, and everybody, especially who are older, maybe 62 and over, or maybe a few years below 62 and need to be thinking about your future. We're going to be talking about reverse mortgages. And in full disclosure, I am far from being 62, a little closer than I would like. But I still got a good
You look
decade.
like you're 62.
I feel like I'm 62. I appreciate that. We're going to talk about reverse mortgages. And so let's just get right into it, Melinda. What the heck is a reverse mortgage? Walk us through the basics. And I am going to encourage you. We should have probably told you this before we went live. You're going to want to get a little bit close to that microphone. Pick up your beautiful, angelic voice. Get as close to the microphone as you can, but be as far away from Justin as you can, because that's always a good rule of thumb.
That's the main rule, yeah.
You got it. You got it. That's a really good question. And it's interesting that you said, what the heck? Because the acronym for this reverse mortgage comes from Home Equity Conversion Mortgage. And so it's called the HECM. So what the heck is a HECM?
Oh, okay. I don't know.
Well, it's a wonderful retirement tool. And it's so amazing because something magical happens when you turn 62. When you turn 62, mortgage payments become completely optional for as long as you live in the house until you're 150 years old.
Okay, I don't have to worry about that.
No.
The only thing I'm wanting to know when that magical age comes where I can walk into a restaurant and get that senior discount. I mean,
Yeah.
I'm pretty excited
always
about
talking
that.
about that.
Yeah.
No, but this senior discount takes the cake. And you probably have heard on the news lately, and I talked about this with Justin, that the buzzword is silver tsunami of home buyers right now, taking over all of the home purchases and not leaving any inventory for anyone else. Well, although that could seem like bad news, that's actually really good news because there's a whole demographic, a whole market for you real estate agents to take advantage of and to help and assist these clients have a better retirement by, in some instance, doubling their purchase power.
So how does it work? And Justin, you can feel free to jump in and help lead the conversation. How does it work? So I'm 62. I'm going to go out and buy a home. What am I looking for? Or I am 62, and I got X amount of equity in my home, and now I'm wanting to take advantage of my retirement plan through real estate without actually having to sell my home and go move somewhere. Because that's the stress. Yeah, I've got all this equity in my home, but the only way for me to access it is either to do a cash out refinance, which is going to be expensive, or I've got to move in with Junior. And that's not, I don't know if my kids would take me in.
Yeah.
They wouldn't.
And not to mention the required monthly mortgage payment. And when you're in retirement age, you're trying to eliminate that liability. So an interesting fact is there's over $12 trillion in equity in seniors' homes right now, tied up, illiquid. And so we call that a lazy asset or a dormant asset.
We call Justin a lazy ass.
He's always on point with this kind of stuff.
Oh, yeah. Yeah. So we need to figure out how we're going to unlock this equity because they're sitting on a gold mine. And the retirement years, they're supposed to be the golden years, but a majority of retirees are living paycheck to paycheck. 80% of retirees depend on Social Security income.
Mm-hmm.
Of those 80%, 43% still have a mortgage. Can you imagine that? Almost half still have a required mortgage payment. So you're already taking a very strapped down, tense situation and making it much worse. But what I wanted to explain to all of you and your agents is now you have a solution for them to be able to free up that liquidity, to be able to use their housing wealth to benefit their retirement.
All right, if you are 62 or over, or you're approaching those years and would like some more information about reverse mortgages, all you got to do is text the word reverse to 623-AZ-RECON. That's the word reverse to 623-AZ-RECON.
So let's say, Mike's 5 years away from 70, and he's got a home that's
Shut
paid
your
off
mouth.
in Prescott. Okay, it's too cold. That's the only house he owns. It's too cold up there. He's looking for a home in Tucson, and he still wants to have that property, or maybe a smaller property in Prescott. Walk me through how this works. What do I need to do to make sure that I can have a reverse mortgage on my primary home? And maybe I don't want another mortgage at all. Does this something that happens often?
Yeah. As a matter of fact, you were just describing a scenario that just recently happened. And there was a seller in Prescott. It was too cold and he wanted to move to Tucson. And he netted just under $1 million. So he purchased a home in Tucson for $700,000 and put down $500,000. So
On a HECM?
yes, using a HECM.
So he had a $200,000 loan on a HECM, but he doesn't have any payments on it anymore. Okay.
Correct, 300. Yeah. Yes, 200. So no payment, but he can make optional payments if he wants, but there are no required monthly mortgage payments. So he ended up having almost $500,000 left. So what he did was he went ahead and paid cash for a second home in Prescott. So now the agent had a listing, got to have the buyer side and the sellers, or two buyers, so two homes. So the home in Tucson, the home in Prescott, and the listing in Prescott.
Let's go back to the home that he purchased in Tucson. Now, am I wrong by assuming that also came with a line of credit that continues to grow based on what the interest rate is year over year?
Yes, all HECMs come in with a built-in line of credit. So with a purchase, you have to fund it. So if you do make payments, it generates a line of credit that you can access dollar for dollar.
If you make payments on what?
The mortgage. So
Okay.
it pays down the current balance.
So, okay, so like always, I'm going to make this personal about me because that's pretty
this
much
is
what
your
I'm
scenario.
going to. So my wife and I, we are 8.5 years apart. And do I have to wait for her to catch up to becoming 62? I turned 62 and I've got, $800,000 worth of equity on the home and I want to do a reverse mortgage, but she's 53. Do I have to wait for her to become 62, or am I in a situation where I just go ahead and buy the house myself? But I'm still married. I still technically have a spouse that's under the age of 62.
Yeah, absolutely. So what happens is she is eligible to be on the HECM with you because only
Finally, a benefit for
Yes.
marrying an
Wow.
older dude.
I
Yeah.
know. Yeah, your sugar baby. So as long as one person is 62, you're fine. And one of the silver lining to this is she can stay there until she's 150 as well with no mortgage payments.
Good chance she'll make it that long.
Yeah,
Yeah.
yeah, she's healthy.
Yeah.
She does
Right,
everything
right.
that you don't do.
But one of the things that I like to clear up right away is when people hear reverse mortgage, they kind of freak out or say, no, it's a horrible loan. We've heard so many bad things about it. Well, it has gone through so many revamps since its inception in 1988. And the first HECM was actually closed in 89. And then reverse for purchase, which we're talking about, came in 2009. And so the
So do I have to have a house completely paid off in order to do a reverse mortgage? So, for instance, my house right now, we owe, I don't know, call it $450,000, and right now, if I were to put it on the market, it'd probably be worth about 1.2. And let's say now I'm turning 62 today. Can I take advantage of that equity, or what happens to the original mortgage balance?
okay, so in this instance, if you were to retain the property,
Yeah.
this is what Justin was referring to. When you do a refinance, and if you owe less than your principal limit, which you do. The difference between your loan amount and your principal limit is a line of credit that you can tap into anytime you want, as often as you want, tax-free. So this is also used as a really nice strategic retirement tool, so that you could actually fund and supplement your income using your line of credit, which is tax-free, rather than having a taxable event with your assets under management. And you can leave those there to let them grow.
But I in that situation, I would still be required to make my original mortgage payment, or what happens
No,
to
sir.
that? That just gets wrapped up into a new loan?
Yes.
With
All
no
the-
mortgage payments.
Oh, dear.
Yeah. The payments get paid.
62 just can't come soon enough.
I know.
pal.
You're right.
Seriously.
You said something about principal target rate.
Principal limit.
Principal limit. How do you figure out that principal limit?
Okay.
Is it calculation?
Yes.
Is it an easy calculation to where our listeners could do this calculation on their own, or do they need to talk to us?
Yeah, they do need to talk to us because it's an algorithm based on 3 things: the interest rate, your age, and the value of the property. So based on those 3 things, depending on how old you are, it's going to dictate what your down payment position is or your equity position is for a refinance. So the older you are, the more you can borrow.
Now, I'm not asking you to say specifics, but let's say that I mean, you're 62 years old. If I had 30% equity in the property, am I going to be able to qualify for this product?
Yeah.
Yeah?
Yes.
Okay.
So if you're 62 years old, your principal limit will be in the mid 40% range. So you'd be able to pay off your mortgage and still have a small line of credit. But there's something really fancy about this line of credit.
You're saying, okay, I was saying my loan to value is 70%, or I have 30% equity. I think what you're
I
saying
thought
is
you
you
said
need
the
to have,
opposite. Yes.
yeah. You're
Yes.
saying you need to have about 40% in loan and then 60% in equity. Okay,
Because
at
at-
62.
Yeah, because at
Okay.
82, you go up to 50%. So that's kind of the sweet spot, is you only need 50% equity. So the younger you are, the more equity you do need.
Now, what we have seen is individuals that may have 30% of equity in their current home that might be a $2 million home, downsize, move into something that's $400,000, put 50% down, and take advantage of the HECM, right?
Yes.
That's pretty common, and then keep all that money, make it work for you, buy other properties. And not have that liability of that first mortgage on your primary residence.
And as I mentioned, the majority of people think there's only 2 ways to buy a house: cash or with a mortgage and a required mortgage payment. What this does, it enables them to still have no mortgage payment, but keep some of that cash in their pocket. So if they have $500,000 to work with, they could buy a $700,000 loan or more
Home.
property, and they're going to be able to retain a chunk of that in their pocket, liquid cash, instead of having it all tied up in tangible in equity.
All right, if you're looking for some more information about reverse mortgages, Melinda Debus is our expert. All you got to do is text the word reverse to 623-AZ-RECON. That's reverse to 623-AZ-RECON. All right, 2 of my glaring questions, and I think are common questions from when I'm talking to people out there. Okay, so let's say my house is worth 1.3 mil, right? And through my life and my wife and I die, and let's say there's still $500,000 worth of equity. What happens to that equity? What happens to my heirs when they take over the house? Is it just all gone, and does that now go back to the bank, and then the bank benefits from that equity?
Good question. A reverse mortgage is recorded no different than a forward mortgage. Only your name is on title, and when you sell the home, the transaction is exactly the same as when you sell a home with the forward mortgage. The proceeds pay off the
Gotcha.
mortgage balance, and in this sense, the mortgage balance would include the payment arrears that would be added to that. Every penny of the proceeds goes to your heir. But this sparks another question, another nuance about this program. Are you familiar with the term non-recourse?
Yeah. I hate when people
yeah.
ask me on camera,
All right.
like, do you know the definition of
Yeah.
something? Because
You're
I'm
like,
pretty
"Do
much
what's gonna
going with
happen?"
no.
Do you know the definition?
I'm pretty comfortable, but go ahead.
Okay. Well, it's a legal term that basically means no personal liability. And so that is a huge benefit with this and a massive layer of protection for the HECM because it guarantees that you can never owe more than the home is worth. And now in our marketplace, we think, well, that's not a problem. But no one really did predict, per se, 2008 when that happened.
Sure.
And it was a free fall of value. So if that were to ever occur again, this mortgage is 100% insured through FHA. So if that ever did happen and there became a deficiency, we will file a claim against the insurance and pay the entire deficiency.
So my next question then is, let's just say let's say I've got a $700,000 credit line for lack of, a better term. And I fortunately or unfortunately, depending on who you are in my camp, I live a lot longer than to be expected. And now I have reached that $700,000 credit line and I still need money and I'm still going strong. What happens? Am I just I would assume I'm just turned off now.
So are you using the credit line or is it just continuing to grow?
Oh, I would assume I'd be using the credit line for retirement, taking X amount of dollars a month to help fund my retirement.
And we're assuming that this is a HECM credit line, correct?
Correct.
Okay.
Yeah. So in that case, if you've had it for that long, the likelihood is you could refinance into a new one, provided the values have grown, because that will reset your credit limit. So your credit limit is only growing based on the unused credit line.
Assuming that was from a purchase.
No, or refinance.
Okay.
Either one. So with the refinance, it's built in because typically the payoff is not as much as the principal limit factor that you
Right.
are qualified for. So the difference between your maximum loan amount or the principal limit and your payoff, that is your line of credit that you have access to interest-free.
Well, you know who this is bad news for? It's my kids. Their retirement's going, I'm going to be able to use my house to fund my retirement.
See, and I don't see it that way because you're keeping your other assets going. And so those other assets that your money's working for you,
Yeah.
you're going to take it from one place to spend the money, right?
Yeah.
All right. So what's the starting point? So we have some listeners. They text the word reverse to 623AZ recon. What are some of the qualifiers? What are some of the things I need to consider? And what's that qualifying process? Because, we all have a kind of an idea of getting a regular, FHA mortgage or conventional loan. We kind of have an idea of what that process looks like. Is there any difference with this? Anything I need to be intimidated by, or it's just as simple as just text in and go through some paperwork and easy peasy?
Yeah. There's actually three major differences. The first one, as another layer of protection, is there is counseling, and it's an hour counseling over the phone, HECM counseling, to make sure that you understand
I would like to be the counselor on some of these calls.
to make sure that you understand your requirements, because you still have to pay taxes and insurance and keep the lights on. So they want to make sure that you understand that. The other two differences, there's no credit score requirement. And there's no DTI because you're not qualifying to make a mortgage
Debt to
payment.
income ratio.
Yes.
Yeah.
Thank you. I take it for granted.
Yeah.
That we
It's
know what
okay.
that means. So debt to income ratio doesn't play a factor. So instead, we formulate a residual income. And that's basically just enough money that's coming in that can pay your annual taxes, insurance, HOA, and keep the lights on.
So I'm assuming that there's going to have to be some sort of appraisal done,
Yes.
right? And they're going to come out and do an appraisal on the property, right?
Exactly like a forward mortgage.
Except there's two of them, right?
20% of the time, FHA will call for a second. In all of the HECMs I have done, I have not had the call for a second appraisal, but as a disclaimer, we do have to put it out there.
Okay, so you've mentioned FHA a couple times then. Is there because I know if I'm going to go out and get a FHA loan as a home buyer, there's a cap that at FHA, that my FHA loan can't go above. Are we talking the same things as far as some limits here?
Yes. And I didn't bring that with me, but it's over $1 million. So sorry.
That's
I'll send it to you.
perfect.
They just increased it. But just like a regular FHA mortgage, all of the same property types. You can do condominiums, single family, double wide manufactured, PUDs, townhouses, and your typical single family resident.
What if I had a house made out of bottles?
That was we
talked
had one of those a couple weeks ago. It was great.
All
Well,
right.
the market's always changing, so let me look into that.
Yeah.
All right. Melinda Debus with Justin's team, the Frederick team at Fairway Independent Mortgage. Appreciate you joining us today. And if you'd like some more information about reverse mortgages, we encourage you just to text the word reverse to 623-AZ-RECON. That's reverse to 623-AZ-RECON.
Thank you for joining us on the Real Estate 401k Show. If you want more information on how to build wealth, click on the link or text us at 623-297-3266. That's 623-AZ-RECON.